Hey, it's Mike again. This is going to be a fun one. Yes, I say that almost every time, but I really mean it. This is going to be the Webby RSI, at least Webby RSI Part 1, that we're going to be going over is one of, as you could can tell by the name, is one of my inventions. This is based off of the relationship with the stock or the index and it's 21-day exponential moving average. Some other things in there, but that's pretty much what it is. And this is not the RSI that you would have thought of or heard of, that's out there. That's very very popular, kind of overbought, oversold indicator. I just don't use that one, but this was a play on words. This is me trying to have fun, and I called it the RSI, the Webby RSI, because it originally stood for Webby's Really Simple Indicator. And so it since got a little bit more complex, but the concept is still simple. It's just some of the ways that I've displayed it are different from my version 1.0, which we'll get into versus the version that I have right now is the 5.150. Because I like, using that wherever I can. And so it's been modified, and, I can modify it more over the years. But yeah, we're going to walk through what it is, how and why I invented it. And then more importantly, how to use it, right? Because that's really what it's about. It's, I do the backstory to kind of have a record of this stuff. As anyone who's watched one of these before knows that I'm doing these for two real reasons. The first reason, having something for you that's free. That's, we put a lot of stuff out on IBD that's both free and there's a cost involved. And I wanted to have an outlet for things that I didn't have time to do at work, and under that umbrella, and just do my own thing and have it out there for you guys for free. I could be charging for a lot of these. I probably have to edit out all my ramblings, but I could charge a lot for them. But I'm deciding to put this out for free to help people, because I remember when I started off, I didn't have just buying an investment book for 10 or 15 bucks was like, wow, that was a commitment. And any of them that were like 70 bucks or 100 bucks, it was like, wow, that was better be a good book. So I wanted something free. But, why I let myself ramble is I wanted to have something. I was going to make some videos just for personal reasons, to have for my kids to watch someday, or, if they're 23 and they're not into trading, and thought if they ever get into trading, I wanted them to know what, how daddy did it, and, to learn from me. And then, if they have kids someday, to share with them, because who knows, maybe my grandkids will be into trading. And if for whatever reason I'm not around or mentally sound, I wanted to have this information there. And I thought, what? If I just put it on a computer, that could get lost. If I put it out on the cloud, especially through YouTube, it's most likely to stick around. So if you get annoyed with my going off on tangents and stuff, it's like I feel like I'm talking to my kids or grandkids, decades from now. And just, that's in my mind how I'm just telling whatever stories that I'm telling. And so bear with me there. You can listen at 2x speed during that. And I appreciate the patience. And every once in a while, some of those tangents end up becoming very relevant. But anyways, this is about, and I'll just share, but before we get into that, if this is your first one, I'm going to walk you through the rest of mine and kind of where to go, where to start. Let's share my YouTube channel on here. So this is, well, if you're watching this, you know where it is. It's the Webby 5150 is my channel. And here are all the different ones, starting down here with the first episode on precedent analysis. And I was using the December 18th bad break as a model. And it was really the concept of searching for precedents in the market. It's very, at the core of what Bill did, and Bill O'Neill, the founder of IBD, and what I do. And so that's that one. I would still watch that. I think it's very important. Then I have a series on model stocks, and that's what you find in the front of how to make money in stocks and all those models. And that's what everything that Bill created and that we created, it was based off of, and off of studying models. And the concept is stocks that have had big runs in the past, you want to study those, what they look like at the beginning, middle, and end as a guide for future ones. So I talk about how to do that in episode 2. And then in episode 3, we go over our first one in detail, the Cisco's original move. That's number 3. Number 7 is Apple, the same thing. It's big move. Google's big move is number 8. What else did we do on that? We did Amgen was number 15, and number 16 was Taser. And man, Amgen is probably my favorite of those, just because of the connection with we go over how Bill traded that to a certain extent. And then other things that are in this category of my inventions would be like number 4, created the IBD composite rating, why I created it, how to use it, what goes into it. Same thing, number 5, the growth 250, how and why I created it and how to use it. A general one of how to use market. Sorry for my voice. I'm having a bad voice week, frankly. And that's number 6, how to use market surge. Number 10 or number 11 is about fear. It has nothing to do with the market, but it has to do with a lot of personal things and things that I discussed there on a very personal level, one of which is my vocal cord issue that is acting up this week and kind of the story behind it. And I think it's should be very inspirational. And I would really say I would like people to watch it. Not many people do, and I understand why. But then if anything else, if you don't do anything else, certainly do the general market ones. And the first one there, and really goes along with what we're doing today, the Webby RSI, is because the Webby RSI is based on the 21-day. And number 9 is how I kind of came up with the 21-day as a core part of everything that I do, both on indexes as well as stocks. Then number 10 is the first part of the follow through day. The second part I did in number 13, and that was specifically for follow through days underneath the 200-day, which is very relevant for our current market. And then market crashes like we had recently, and everyone thinks back to 87 and 29 and stuff, and so crashes come in all sizes. And so that's number 14. I would go over that one. And I forgot the number 12, which is the 3-month RS rating that I developed, and why I developed it and how to use it. So feel free to watch all those. Again, what I would do is when you're done with this, I would go watch number 9, because that's on the 21-day, and you'll get a lot more out of it. Then I would do number 9, number 10, 13, and 14. I would do it in that order. So 9, 10, 13, and 14. And then from there, probably go down to number 2 on the models, and then pick whichever one is interesting to you to do first. So the Cisco, the Apple, the Google, the Taser, the Amgen. So that's the channel. And hopefully that is helpful for you. Let me stop sharing. So this is, it's a really good resource, and share it with people, get the word out, because I'm really disappointed in the number of views that they're on there, because I look at the views is how many people I'm reaching, and I'm putting a lot of time and effort into doing this, and I've committed to doing it for free, and so people should watch. But anyways, it is what it is. Yeah, I know the length scares people. So we are going to get into the Webby RSI now, and let me share market surge. You just kind of start us. I get this arranged a little bit. Okay, so here's the current NASDAQ chart, and the green line is the 21-day exponential. So if you don't know how to put that on there, just go into here, go up to the tools, go to the moving averages, click on 21 day and put exponential on there. And so that's a green line. Your 50 day is your red line, and your black line is the 200 day. But we're focusing in on the green line. And without rehashing everything that I did in the 21 day episode, it really found that the 21 day is really the most important thing for me when I'm looking at the general market. More important than follow through days, distribution days, anything, frankly, is the relationship of what the market is doing and the 21 day. And the same thing for stocks. But today we're talking about it from a market standpoint. I'll do another one of these on stocks. So if you're kind of in three different phases when it comes to the 21 day, you're either living above it, you're chopping around, or you're living below it. And so we want to be able to harness the time where you're living above it, meaning your low is above it, and staying above that for a period of time, because that's really where, I've found that, I make the most amount of progress in the market, and I tend to get hurt the most really when you're going back and forth, like in here, this time frame, in there where you're going above and below it, and you're not able to stay above it. That is really where I get chopped up the most. And if I'm following my rules and you're in this downtrend where you're living underneath it, that's normally not a problem, because I'm pretty much out of the market. It's when I don't follow my rules. Yeah, that happens to me too, and you do stupid stuff, and you find out not to do stupid stuff. But luckily this time I didn't do stupid things. So, but anyways, so it's really that relationship of your high versus a 21 day, which is a bad thing, your low versus 21 day, which is a good thing. And so when I'm looking at, let me stop share for a second. So when I'm building indicators, which is one of my favorite things to do, frankly, is I want to be very pure with it. I do not use secondary indicators of any kind whatsoever. So meaning, and I discussed that in one of the market related ones. I forget which one it was, maybe market crashes, where I don't use bull bear, I don't use put to call, I don't use VIX, I don't use any of those things, because they're measuring other things. That what I want to do is, if I'm interested in the price trending, then I want to focus in on the price, and is it trending, and just look at ways of measuring the price itself. I don't even use volume, because I've determined that I believe volume data is dirty and keeps getting dirtier every year. And I've discussed that in some other episodes. So really, I'm focusing on the price action. And that makes it simple, right? Because what do you have with price? You know for a fact what the price is. Like, you don't know anything else for sure. You don't know, is that volume really buying demand or selling pressure, or is it a bunch of algos, or is it a bunch of ETFs, or is it whatever? You don't know. Are the fundamentals, like, is the stock trading off the current fundamentals a quarter out, current fundamentals plus 2 quarters out, or is it a story stock 3 or 4 years out? And you just don't really know for a fact how those fundamentals are going to play out in the future, because they're just estimates, right? It's either your estimate or an analyst estimate, and that's not certain, right? And you do know historical factual earnings data. That is something, I do look at. I look at a lot of fundamental stuff, but from a technical standpoint, you've got your open, your high, low, and your close. Those are the things that you know for sure. So all of my indicators, I try to base those around the open, high, low, or close, or a combination of those, and then the rest of the what's going on. So it's like, moving averages, or the how much progress it's making, how much is it up or down, where did it close within the range? Did it close at the high of the bar, the low of the bar? Did you uh, was the close higher than the open? So I've got indicators on everything. The spread, so the average true range, lots of things around there, but it's all pure. So if I want to know what the market is doing and trending, and that's a big part of what I do. So I know everyone likes to look at option data, and there's so much. I know there's a lot of value in there, but you've got to think: are you smarter than that other person or computer that's looking at that same thing? And that edge, or if you're looking at, you know, all sorts of very interesting option related data, like you better make sure that you truly have that edge that you think, or is that known, and then you have to have an edge on top of what is already known. So that's where I think that from a purist standpoint, um, just looking at the actual open, high, low, and close data and basing everything around that. And you can just look at a chart with nothing on it, right? And that's fine. And if that works for you, that's fine. But there are things that, like for me, saying the importance of the 21 day and the low versus it, I was thinking, wow, I really just want to know that difference. Like, what is the difference? So I'd start measuring, okay, the low is 0.2%, um, above the 21 day, or it's 0.5, or it's 1%. And I'd focus in on that and just be looking at the data. I was like, no, I really want something that gives me a graph of that. So I was like, what is the easiest way I can do that? And I just thought, well, I'm just going to do this histogram of the low, and I'll show you in a second, but the low versus the 21 day, and just plot that. And originally with version 1.0, I just showed that, nothing else, just and that's why I called it the Webby's Really Simple Indicator, because it was simply the low versus the 21 day exponential, nothing else on there. And I have a little histogram on the bottom and measured it in percentage terms. And originally found that, like looking at the Qs and the NASDAQ, that kind of the sweet spot was 0.5% to 3%, was kind of where you wanted to be in most cases. There were exceptions. And then when I started looking at different instruments, so let's say I was looking at the Qs, and then I started looking at the QLD or the TQQ, it became very obvious that the percents were off, right? Because it's the same instrument that you're measuring, but now you're measuring it in percentage terms. And so let's take the extremes, like the Qs versus the triple leverage, the TQQ. Well, then I would have to mentally go, okay, well, I'm looking at the TQQ, and so 3% is really 9%. And then that got away from being simple and it got a little confusing. And it was the same thing when I was doing it on a stock level. If I was trading something like Walmart or Costco that is really kind of slow and pokey, 1%, your low versus your 21 day, 1% on, or let's call it 3% on Costco is huge, versus 3% on your favorite high flyer. Let's call it, whatever. We just did Taser last time in episode 16, and that was this monster move back in 03, 04, and it had this huge move, and it was a very volatile stock. So just being 3% above your 21 day on something like that was not a big deal. So I was like, let's do this in a relative, change it to be relative to itself, so I could compare instruments. And it was around the same time I was really getting absorbed with the ATR, the average true range, and just thinking that is really the answer to a lot of ways of measuring things. So instead of percent terms, terming it, doing it in terms of ATRs, average true range, is really allows you to compare apples with apples. Like if a stock, same thing. If Walmart moved up 3% today, and Taser moved up 3% today, it's completely different. That is, if let's say Taser's average true range is 10% and Walmart's is 2%. Well, a 3% move on Walmart is abnormal, is an unusual move, where is the same 3% move on a stock that normally trades 10% on any given day. That's telling you it's tightening up, like it's that's really contracting a lot, and so it's apples and oranges, or kumquats and tangerines. It's really different. And so then I converted everything into ATR. So I did that. And then I was like, well, you know what? There's probably something to this, where the high being underneath it. And well, you know what? It's about time I show it to you so you can see. So this is not going to be in Market Surge. This is actually going to be in Trading View, and something that I had an old colleague of mine just build for me in here, because we don't have it in Market Surge yet. We're trying to do we have to make a lot of changes to the code to allow us to do things like this. So it's going to take us a lot longer than normal. So if you want to use this, there's several places out there. You can just Google or ask around on Twitter. I can't really promote other services because it's not really kosher to do that. But I'm just being frank. I use this. I'm using Trading View for this, and it's down here. This Webby RSI. Let's just blow this up. So these are the histograms. So this little blue thing here, this histogram, is telling you, and these are ATRs over here. So it's telling you that today, that the low versus its 21 days, let's call it 0.5, a little over 0.5 or half an ATR difference, right? So you've got a little bit of a movement in there. And that's what you want to start seeing. That's how you start off. And then you want to see a wall of blue, which we'll see in times like this. This is when it's trending. That's when your low is above it for a period of time. And we'll get into some examples. But I thought, you know what? So the original version, again, this over here was in percent instead of ATRs. Now it's converted to ATRs. So let's just show you the difference. So we'll put Qs in here. And you can see that's like, 0.5, give or take, ATRs. Now we're going to put TQQ. And before it would have been 3 times that amount. But instead, sometimes the math works out a little bit different. It's, just up a little bit from there. But essentially, you kind of get the point that I wanted to make things equal, or as close to equal as possible. So you can see on this spike here on the Qs, on the downside, that got to like 3.5 ATRs. And let's see where TQQ was at that same time. Yeah, about like 3.25 or so. So in that same general area. But let's go back to the NASDAQ composite. So with this one, this is the distance from the low versus the 21 day. And that's what I added with the version 5.150, is your also in ATRs, but your high versus your 21 day, because I wanted to see if there was anything to that. And did you get stretched to the downside and expected to do, I don't like to use the term overbought, but and oversold, but you're kind of at an oversold level that is the market's going to want to go back to neutral. The market is always, it's kind of like, the old saying of, object in motion wants to stay in motion. So once you get the momentum going, it wants to continue going, and then until it starts going in the other direction, and it wants to keep going in that direction till it kind of gets an inflection point and turns. And so that's what happened on this way down here. And you'll see that, I put a couple levels on here, like 1 ATR, 2 ATRs, but in red, I have 3 ATRs, because I've noticed that typically when you get 3 ATRs away from this 21 day, you tend to be near an extreme. So you can see that on March 11th there, it got right up to 3, and that was a short-term extreme. And so that's your distance, your high versus your 21 day, which is the green one on here. The purple is the 10-day simple. We'll get into that in a second. And so that distance there, it doesn't have to, but it wants to mean revert. So it bounced back up, got close up to the 21 day, and your low really couldn't get above it. And then it started coming back down. And then this time it hit this extreme value on this day, on the 4th of April, even though on the 7th of April you hit a lower low. This is measuring the distance from your high versus your 21 day. So actually, this day was an extreme, and it was 3.7 or so. So that was telling you that you were getting to a point where it was very likely for it to turn back. It doesn't have to, and we'll see examples where this gets a lot worse. But in this case, it kind of did it in a normal way. So what you want to have is now for it to build on itself, and you want to see a wall of blue of telling you that that trend is going to continue. So we'll see how that plays out. Now let's just go back to some other times in here. Oh, I'll go over the 10-day simple. So something I used to do back in the late 90s is I would do an extension of versus the 10-day simple moving average of when you get really far apart, and it was a way for me to sell some into strength, which is something that I'm very don't do a very good job at selling into strength. So it was a reminder to myself. So when that's this little line that you see on here, a little orange line that's not the histogram, and that is just your high versus your 10-day. So I know it started off as a really simple indicator, and it feels like it's getting a little bit more complicated, but it's really not. It's just how is it versus your 21 day, and how is it versus your 10-day expressed down in the bottom. And let's just blow this up quite a bit. So you can see in here, this one is saying your low versus your 21 day is positive. That's why it's blue on there, or teal. I'll call it blue. And then on this one, it's saying the orange, your burnt orange, is your high versus your 21 day, and express in ATRs. And then this one here, this little squiggly, that is your high versus your 10-day simple. And again, that came out of just some work that I'd done during that time in the 98, 99 time frame, where I found that it seemed like it was about 15% back then, that when it would get up there, it would tend to stall out, run out of gas, and then kind of mean revert. And then, so I'd sell into that and then add a little bit later, and then, try to sell again. That was the ideal type of thing. It didn't always work out that way, but I thought, percentages have changed a lot since the late 90s. And I was going to do this as a separate indicator, but I wanted to just put it on here. I might take it away at some point and make it its own thing. But for now, I've got it on here, and I know it does add some confusion, because in this time frame in here, some people might think, oh, that's a moving average of that, but it's totally separate. And there again, I'm looking for spikes really around 3 ATRs or relative to its prior peak. So you can see here in August of 24, that got up to near 3 ATRs away from its 10-day, and then started to roll over. This one, same thing here on June 12th, and got stretched, and then came back in. So for today, we're going to call this the Webby RSI Part 1. And let's just, to simplify it, we're not going to talk about the 10-day, that little line, and we're not going to talk about the burnt orange being underneath the 21-day. We'll do that for another episode. So right now, what we're going to be doing is focusing today's session on market turns, and how that you can use the Webby RSI to tell you, is that market trend healthy, and is it building on itself or not? And of course, I did just record this week that'll probably go out in a couple weeks, in a week or two, of Webby Rambles on power trends. And so with a power trend, that has a lot to do with your low versus your 21-day, plus some other things there. But it starts off with your low versus your 21-day, and being above it for 10 days is one of the things. So that's kind of a wall of blue that you would have by definition. So let's start going through this. So we don't know, I'm recording this on April 25th, and I try to not make these about the current market environment, because I do that in IBD. Like I did the recorded earlier today, every Friday I do an SMT Stock Market Today video with Ali, my colleague and good friend. And we go over the market, the current market, and my thoughts on that. And then every Monday, Wednesday, and Friday, I'm on IBD Live, and with 3 other people. So there's always 4 of us on there. And that's in the morning, like 10 minutes before the open. And we do that for, I don't know, what is hour and a half or something. That one is paid. The thing on Fridays is free. And that's a ton of fun. And then the second Tuesday of every month, I do a thing with Swing Trader, with Justin, with my good buddy Justin, and we go over what we're doing on Swing Trader, how we're looking at the market, um, and all of that. So let's go through this, and let's look at this turn, because this is a good example. So this is the NASDAQ, and we're going to stay on the NASDAQ today. And this is July 19th of 23. And then you start your 3 waves down. You see that? 1 wave, 2 waves, 3 waves. And then you turn here. We're not going to talk about follow throughs or anything, but again, we're focused in on this green line. Can you see that? I don't want to mess with all that, right? Hold on a second. Let me stop sharing for a second. Let's see if I can make those settings a little bit better. Just 1 sec. Okay, I'm back. I made some changes to that to make it a little easier for us to read. So I got rid of, oh shoot, I thought I got rid of that. I did well. Oh shoot, it saved it the wrong way. Let me make this, I'll just make this change on the fly. Settings, style. We're going to get rid of the 10-day, and we're going to make this 21-day a lot brighter. Okay. All right. So the green is the 21-day, and it's very faint, the 200-day. Let me make that 200-day a little bit, and make that white, and we'll make it a little bit bigger there. And same thing with the 50-day. We'll make that a little bit bigger. Okay, that way it's a little bit easier for you guys to see. But really focus in on the green one, but the white one is your 200-day simple, and your 50-day is your is in red there. So we're going to go back in time. Let's just start here. So this is your turn here in 24. This is May 3rd. So your low gets back above your 21-day there, and it stays above it. And look, notice how you get this wall of blue, and that's your sign to yourself and as a reminder to me that, hey, this is a good market, and you want to lean on the side of being aggressive, lean on the side of having your foot on the gas. Now, when you don't have it there, like even on this day here, when your low went back below it, that could have been your first sign of going much lower, like it did over here. And so that's when you're starting to back away. And how it does it is also tells you how quickly you need to tap on the brakes or take your foot off the gas. So if it would have fallen through dramatically like it did over here, then you're going to be a lot faster. If it has an upside reversal on there, then you're saying, okay, now the low of that day becomes very important. The low of this day on May 31st ends up becoming very important to stay above. But you can just see, again, it's just a very simple thing. And you want those values typically to be between a half an ATR. So that would be down here, up to 3 ATRs. Once you get up to 3 ATRs, you'll notice that you kind of are running out of gas. Now, there are times where it can go a lot higher, but in general, unless you're in a real like kind of bubblish type of phase in the market, it tends to run out of gas around 3. So what does that tell you? When you're up there near 3, like 2.5 to 3, you still got your foot on the gas, but you don't want to be, you want to be taking some offensive trades, doing some locking in some offensive gains, as well as any new positions, being very careful, like don't get carried away, because you could be right at a natural time for it to mean revert, as it did right there. So it, kind of told you here, then it pulled back in, told you here it was at 3, and then it pulled back in, and it got a lot worse. And then of course we'll go forward a little bit. Here in September of 24, you started going above it, but it wasn't that huge wall of blue like we had before. It was never really even getting up to the 2 range. So even though it traded up, it wasn't super powerful the way it was before. It did get a little bit of this here, but what happens is when you start to understand this indicator, that when you come from a 0 or negative number and come back up. So what we had here on October 31st, when we broke the 21 day, that means it's going to be a 0 number, right? Because your high isn't underneath it, so you don't have a negative value that we show as a positive value, which is really the burnt orange when your high is underneath it. But it's basically a shakeout, and you should get power when you come back up, and that's what we got here. But then it faded right away, so that was a little bit of a warning sign that you were in kind of a choppy time frame. And then here's that December 18th bad break that we had, and we haven't been the same since, in which was again the first Webby Rambles on episode was number 1 was about this day. So definitely go watch that one. So let's go back to the one we were going to start talking about. This is that 3 waves down. Again, started on July 19th of 23. 1 wave, 2 waves, 3 waves. You get your low back above your 21 day. That's your first sign that things might be okay. But that happened over here too, right? In October, but it only stayed up there for a couple of days and then came right back down. So that's why I'm leaning heavily these days on your low being above it for 3 consecutive days and closing up on the day. And for markets school, we used 5 days for a lot of things, but I've found that 5 being a little too late, 2 being a little bit too soon, and 3 kind of being your Goldilocks. I mean, there are exceptions to everything, but you don't want a signal to be too late, and you don't want it to be too early. So 3 days being above it, really above a moving average, is more meaningful to me, a lot more meaningful. So here you got this wall of blue, and this is very normal to get this power where you came almost up to 3 ATRs, your low versus your 21 day there on November 23rd. So that was your sign that it was actually normal and natural. And these ebbs and flows with this are normal and natural. Even this little bit of orange that pops up, it's telling you that, okay, it's a normal pullback. It's not going to stay above its 21 day forever. But the fact that it doesn't get far, it doesn't give a big value there, with meaning it would be your distance of your high versus your 21 day. It's telling you this is your sweet spot. That's where you want to trade and try to press that gas. And then of course it rolls, and you see it over there. Let's go to some other time frames. Let's just scroll back. In fact, let's scroll all the way back in time, and we'll move forward, which is something I like to do. I know there's a more efficient way of doing this, but I'm just going to do it the old school way. So this is 73, 74, and so it only has closing values, but still, it'll help to look at this. That back then, the ATRs were so low, and it's a little bit different because since the average true range is really not calculated properly because you only have a closing value. So these are going to be out of whack. So you really can't use those same numbers because there is no range for the day because the high and low is the same, but just that trend above your 21 days. So we won't focus on this too much other than see that when you finally got out of the 73, 74 bear market, which was terrible, you had this wall of burnt orange this whole time, that a little tradable rally here, but then this was telling you that this was different. You could just visually see that all this wall of blue versus what you've had is completely different, and the character is changing, and it certainly did during that time frame. So this is just a reminder. It's telling you what your eyes are already seeing, but it's quantifying it and is allowing you to see those trends nicer. So here it is in 76. This is your time where you'd be making, most of your progress. Same thing here, the end of 76. Let's just go forward until, let's see. Well, that's a massive wall of blue. Again, just, and you can see why I created this is I just wanted something to really show where you should be pressing the gas and where you should be kind of ignoring the little signals that you might get, cell signals along the way. Same thing over here in 78. Let's go forward until we can find open, high, low, and close. So just look at this. This is 1980 wall of blue. And we'll deal with these bear markets in future ones. Okay, here it is in 1982. So the beginning of the bull market, the major bull market. And right away you get this initial thrust, and it stays blue for this whole time, telling you that the character has really changed. And then again, when you dip below it, it's these tiny little moves below it. And this wall of blue. Let's go forward. I don't know when they start using. Okay, here it is. They start using the open, high, low, close, so that the data is going to become more relevant. So this is 1985. Powerful wall of blue there. Move forward. Trying to go fast. So this is 1985, October of 1985. You can see this long trend that you have. And what was different about this one is kind of started off slow. Normally you ramp up a bit faster with higher moves, like right out of the gate. And it took a little bit of time to get going, but you can kind of tell that it needed to get through its 50 and 200 day before. Let me blow this up a little bit more. Okay. And move forward, that wall of blue. And then when the wall of blue starts coming down, that's when you want to start backing away. So even though it didn't break until over here, you could see that it wasn't really the same type of market. So this is where you're going to be more patient in the market, because it's not a nice trending. It's more of a chopping around, especially whenever you see any orange, small blue, small orange, small blue. That's just a chop fest. Let's go forward. So this is the part of 87 that was really good, the beginning part. And this is very kind of typical. This real power, like, look at that. I mean, you got up to 7 ATRs. That's like almost, that is rare. Really, really powerful. Stretched above that 21 day, and then it kind of falls back into a groove there around that time. And then once it tails off a lot there in March, you can see that the trend of the market has changed dramatically. And I just find it so easy to look at this down at the bottom. My eyes will just go down there and just go, okay, good market, bad market, good market, bad market. Yes, you can see it on the chart, but then you can really see how good of a market and for how long. And that's why I like to call it really simple. Okay, so let's, here's the crash. We talked about that in our, what was that, number 14 episode of the market crashes. We've even went back to 1929. I would really suggest watching that. That's a really good one. And you had this blue here in 87 after the crash, and you can see that relative to how oversold, so to speak, it got, and it got a lot worse. That's why it's a dangerous term to use, oversold, that then it was just a different character. It was very weak buying compared to the selling that had happened. And let's go forward. So now it seems like we're kind of reverting back more to normal. You can see where the 3 ATRs, that red line, is a bit more normal post 87. So let's go forward. We get this wall of blue here in late 88. So you can make some money in that. And again, in 89, like really powerful. And let's see. Move forward a bit. 1990, a little bit of a window there. So you really want to pay attention to this. Once you get, 3 of these in a row, like even like over here in May of 90 or March of 90, you get 3 of them, you want to start taking it more seriously. And then that's where your once you get 3 days there, that means your low has been above your 21 day for 3 days. And especially if you close up on the day, you're taking it more seriously and putting on the gas more, as long as you stay above the 21 day. And then you see that was going on there. And then on the 22nd, it fell back through. So that's that. Then we've got this little run here that was a bit more powerful. And let's move forward. Bear market in there. Okay, this is a really good one. So this is in, you would have this major correction there, looks like a bear, and you'd gone up a while, but you're still underneath your 200 day. Remember, this white line is your 200 day, so kind of like now. And then once you were able to punch back through these highs here, and your low is getting above your 21 day, and you get this power. This is the type of power you want to see. I mean, this guy, again, at the beginning is that I know people like to use breath thrusts and all this stuff. I don't use those, but not saying they don't work. It's just not part of what I use. That this is what I think of as thrusting, is when you start a trend, you want to have power behind it. So you really can't get too high. There's not a value that is really too high initially. And this one got all the way up to 7, telling you that things had really changed. And then that continued on for quite some time. And then you ran into some trouble there. Let's see. Let's move forward. Again, like a really nice tradable rally, some big numbers there. And this one didn't pan out that long, frankly. That's 1992. But once you broke that 21 day, it kind of changed into a different character. And so hopefully people see how powerful using something as simple as a 21 day exponential is, and that could help you. So here's this power in here. And you go from, October, and October there initially comes up, and it was weird again with this one, is the thrust up to nearly 5 ATRs didn't happen for a few weeks in there. So that's a little bit unusual, but still you had that power, and then eventually you break, and that's when you really want to back away. And if you're swing trading, there is really nothing wrong, in my opinion, unless you have a major upside reversal of once your low isn't above your 21 day, really being out of the market or very lightly invested. I mean, unless you're a bottom buyer, which is a whole different animal. And that's really just not what I do. I know a lot of people who do a really good job at that. And it's just like you tend to be wired a little bit differently. Let's go forward, see if we can find any other good examples. 1994. So you never know how long they're going to last. And again, this one ramped up, and again, it took a little while, which was a bit odd to get up there, and got to 4 ATRs, and you would have thought it was going to be more sustained, but you never know what the news flow is going to be. I mean, this this is a way to interpret the market, not predict the market. And so you're interpreting and saying, okay, it's healthy, and in a trending phase, I want to have my gas, pressed down. And then when it goes away, that's when you take that foot off the gas pedal and you put on the brakes, and that would be right around there. So you can see it is very simple. Don't let any of the squiggly lines or whatever really get to you. Just think, okay, I want a wall of blue. And while that's a wall of blue, unless I'm getting, hit with some random negative news on my group or something, maybe your stock reports and it misses earnings or has a bad reaction. But in general, if you're just trading things like the Qs or the spiders or things that trade in line with them, and they are doing this, then the wind is at your back when it's going blue, blue, orange, blue, orange, blue, orange. That's your choppy time, and that's where you're really going to get hurt a lot. And let's see here. This is 1995, and look at this long wall of blue. And it's also one of those things where, unless you're getting specific signals of saying that it's really stretched, which we're going to get into in just one second, unless that happens, when you have a wall of blue, you're putting on that gas pedal. So how else do you interpret this? You interpret it versus itself. So here, during this time frame, let's just look at it here. During this trending phase, it was really kind of staying at 3 or under. It got up to over 3 here and then came right back in. So that's telling you, okay, this is how it's trading. And the same thing, over here, it got a little over 3 for a little bit, but then came right back in. Obviously, that one didn't work out as well. So now, as it's ramping up and it's getting into this phase, so that's abnormal and late in the move. So if we would have had this big, massive wall of blue over here earlier in December of 94 or January 95, that would have been normal and natural. Now that is happening later in the move, so it's really a way of saying you've been trending. That's why you have your wall of blue. And then you have this excessive move. It's like climactic type of action. So you're wanting to be not going to cash, but you're wanting to have one foot out the door at that point and selling into strength wherever you have it. And that's what you had over here. Then it came back down to normal, and then it ramped right back up. And again, it's not like it's going to precisely tell you that, on this day you should sell everything. It's telling you the state of the market. The market is excessively bullish and is getting ahead of itself, and it would be normal and natural to have some corrective phases, and then that happened, but you don't really know the magnitude of that. And you can see that happened here as well. So it's just a reminder to be more cautious on those spikes and be selling, especially individual stocks. You might have some things having climactic action or climactic runs or getting really stretched above their 10-day, which is something we'll talk about in future ones. And then you can see this is where it's choppy, orange, blue, orange, blue, orange, blue, orange, blue, blue, orange. This, you're not going to really make money, at least swing trading, in that. Then it starts up again, gets right up to 3 and backs away, then normal and natural, gets and starts off from scratch here and is starting to show some power here, but then it just gets turned away. And again, if you pay attention to these, once you no longer have a positive blue value there, meaning your low being above your ATR, that's when you're starting to back away. I think you're getting this. I don't have to belabor this. Everyone doesn't have to be 3 hours long. Let's go over here. 1997. If you use these to get to sleep, then you're saying, no, Mike, keep on talking. Do some random tangents, because that's when I fall asleep. We'll probably get to some. So here, this is really normal, right? It right away ramps up to 3, kind of backs away, ramps back up to 3, backs away. So normal and natural. Then you get up over here in July of 97, and that's where it really gets stretched. And you can see that on the chart. in kind of climactic action. Doesn't mean it has to fall apart. Doesn't have to fall apart like it did over here. Just pulling back into normal. And then over here, once it goes away, right, you no longer have any blue after a wall of blue. That's when you're getting cautious. And you know what? It would have saved you from a lot of this damage in here because you would have been backing off. And I'm always thinking, just driving my car, like, what gear am I in, And sometimes you just can't get out of second gear, if you're driving to LA. Yes, that's a Sammy reference. If you haven't picked up, I drop so many musical references and I don't even, I just think in terms like that. But anyways, so one foot on the brake, one on the gas. So right here, again, normal and natural doesn't get it as powerful as you'd like. It didn't get all the way up to 3, but close to it. Normal and natural trending in there. Happens again over here. Here's that terrible bear market. You can see it kind of doesn't look that bad on here. It all depends on your scaling. Like, see, if you look at it there, it looks a little bit worse. But that was a 33% bear market. And then you get this wall of blue. And this is where, Bill made a ton of money in AOL and Schwab during that. So that looks good. And good, bad, good, bad. Again, choppy, hard to really make progress there. Then here in late 99, I mean, this was as beautiful as life would ever get, trading wise, and a lot of money was made during that time frame from a lot of people. And you could see that even in January of 2000, it was a different animal than it was, because over here you have this wall of blue that was staying above these high numbers. And remember, we talked about it's okay for these values to get high early on in the move. You just don't want them later on to be those big spikes. And so this was very powerful. And then look at that, a couple of spikes up there right on the top there. Now, that could have gone a lot higher before that did, but when it reached that 3 later in the move was much different than when it was reaching 4 and 4.5 over here early in the move. So it's pay attention to that when you're studying this, is what phase is that in. And then here's this tradable rally that we had in the summer of 2000. Bill traded that, I traded it, the whole team did. We were trading Corning during that time frame. GLW, we're studying, and but it was never the same. You can see that it was never really getting above that 21 day, which was also telling you something. Look at that distance there. Didn't even get up to, at the most, what was it, like 1.5 ATRs right there. So that was a warning that it was a weak rebound rally, is the way kids like to call them. And look, just chop, lots of orange, blue, orange, not trending. A little bit of a trend there, a little bit of a tradable rally, didn't last long. Again, they never even got up to 3. And again, never got up to 3. And here, and this is, in 01, it's a terrible, terrible time. It was a great time because my kids were born during this bear market, but that's that's separate. Let's see. A little bit of a wall of blue here at the absolute bottom in October. That was a lot like the bottom in 1932. Got to do one on that, but it never got up to the 3s there. Now, in fairness, things were really volatile there, so getting 3 ATRs above it would be tricky, but not impossible. But then we have our 3 waves down, classic 3 waves down here, and this is March of 03, and this is when the new bull market really started. And you could see these blue compared to what we had seen during this whole bear, right? This blue over here versus this whole bear market, completely different feel. Now, it's not back to the normal that what we like to see, but you can really tell if you study this how different of a look this is than what that had been. And so certainly tradable rally, but you were hoping to have some more oomph there. that just didn't happen at first, and eventually over here got up close to 3, and then it needed to pull back in. So it's not perfect. Nothing is. Choppy, and starts trending again and is looking really good. And then, then you break the 21 day again, and then you've got this choppy ness that happens. And a wall of blue here in 04 during this time frame. You can just see, like, when you get a wall of blue, that's probably when you're making money. Just like I've always said, when you're trending above your 21 day. And that's why this makes sense, because all it's doing is it's just measuring the distance from here to here and just expressing it in ATRs to make it comparable over time. So just very normal. Let's go through time, a big wall of blue here in 05. Just go for some notable times. This 06 rally here, like you can see from August of 06, really nice power there, and then gets choppy in here, and that's when you'd probably be getting chopped up. So it's kind of a reality indicator. Then here's your 97 or 1997, your 2007 top. Right there, and it's not the same this whole time. There's a little tradable rally here, but notice, kind of like what we saw in the 2002 bear, this never got up very high, which is something worth measuring during the bear market that we have now. And the rally that we have is, does it do something like this, which would be a warning that it's going to be more like a 2000 to 02 type of rally, or 08, 07 to 09 type of rallies that are in there that just fizzle, or do we have more power? So we will see. So that got really ugly. And then here in March of 09, when it turned, you have this sustainable trend there, and lots of walls of blue for the most part. Not, wasn't super easy. It wasn't. And you had this wall of blue here in February of 2010. And so again, this is your sweet spot where you're really gunning it. If you use margin, you shouldn't use margin unless you've been trading for a while and you know that you can really cut your losses and run when you have to. But that would be the time where you would do it, and you certainly wouldn't want to be on margin unless you were above your 21 day, or your low was above the 21 day. And again, here in 2010, look at that wall of blue. And again, that's where you're making your money. A little pullback in there. We'll go forward. Another time in 2012, you should go through and really study these. Let's just go a little faster, see if there's anything worth noting. This 2012 in there, you can see how that kind of ramps up. And they're not really getting those thrusts up there like we like to see, but still some nice tradable rallies, and blue for all of this time. But this one was an interesting one. It wasn't a volatile market. This is 2013, and it would just move up a little bit and then kind of come back into its 50-day, move up a little bit and come back in. So we'll go forward. Tradable rally there, tradable rallies. This is 2015. This is just chop fill in 2015. And if you're paying attention to this, you can see that here in July of 16, that's where you get this sustained wall, much better than over here. Like this wall that we had during this time frame in February of 16, you see how it goes up and then ramps back down to nothing. And it's like a roller coaster. And you want it to be a wall where it moves up and it stays up. And you can see that the visual, that's the distance between here staying up, versus this, it's not really it's staying up there in that same fashion. And it was the same thing over here. It's above it, below it, and that's choppy. But here you get a wall of blue, the wall of, or as Stevie Ray would sing, the wall of denial. Let's see. You've got, wow, a lot of blue in here. What year is this? 17. Okay. Makes sense. And then it spikes up here. This was that, I think they call it Volmageddon, or when the volatility stuff broke, some VIX related instruments broke. And so this one spiked up to 4.5. And then that was, so this is a classic case. This is probably poster child. You have this long rally in 16 that is staying under 3 ATRs. It goes up to 3 ATRs, backs away, goes up near 3 ATRs, backs away, goes up to 3 ATRs, backs away, goes up to 3 ATRs, starts backing away. Then it comes back and it does this. You can see like this doesn't look like the other things. It's a warning sign into strength. And I should have heeded that because I wasn't. I think I was getting excited there because you tend to get excited. Let's just blow that up, during a time frame like that, because you're making money like hand over fist, typically, and then you're just thinking of how much more money you're going to make. But if you use an indicator like this, you have in the back of your mind, it's like, okay, this is the first time we've been over 3 ATRs for a long time. Let me look for any warning signs there are. And another thing you can do is you just focus on like A-rated stocks, like how you would rate it. Not I'll do one on that, how I like to grade stocks A through F, on both on the setup, the fundamentals, sponsorship, technicals. And so you would just be in your best merchandise when you're getting spikes like that, because you know that this might be around the corner, which it was. Another wall of blue here, but it never kind of got up to those other levels. Your bear market in 18, well, that was terrible. And this is what we're hoping that we don't have now. What we're worried about is being in a position like this, where we just have one little blip up there, and maybe we get two, and then we come right back down. So that was in December of 18. So, hopefully that doesn't happen, because that last leg down was really bad, and that's certainly in the cards. Let's hope not. But you don't know what the news is going to be, so you don't predict, you just interpret, and do your best to interpret. So here's another wall of blue here in 19. Didn't get quite as powerful as you would normally want it to, but it did move up nicely and had a wall there. Ran into some problems. Another wall of blue. This wall of blue here at the end of 19. And then we went into the COVID crash, right? So you have the COVID crash, you come out of this, and this wall of blue. And again, it doesn't quite get up to where you would want it to get to. Oh, let's go back to this one. So notice this is a bit unusual. So you're kind of in this. So the 3 doesn't always work perfectly, but I still like really focusing in on it. You're looking at its recent history, because that's its character. How in the recent history, where does it tend to top out at? And in the future, what I'll probably do is like do some levels, kind of like a marked high-low thing, like when your highest bar for 9 bars, and then probably do a horizontal thing across it. But I don't want it to get too noisy, because it is supposed to be really simple and all, but just for me to see that, like, okay, it got up to 2.2, and then it got up to in this range in here. Now it's finally getting up to 3 late in the move. So a bit of a warning on what happened. Then it came in, and then it gets right back up. So that was normal, actually. And then, because it was restarting out, but really this would have been your warning to, it was getting a little hot, a little Althea hot. Then we're going to have another wall of blue here in 2020. That lasted a long time. And you can see another wall of blue here. Wall of blues. Okay, here's in 21. You get this turn here, and then right away, this looks really good. Like at this point, that market looks great because it's getting that thrust, and it's relatively early on. You'd want it a little bit earlier, but can always get what you want. So it's up here, and so you're thinking this is going to be a really nice one, but you don't know, and it immediately comes in, going from a 3 all the way down to like a 0.5 right away. That's that's telling you it's a bit abnormal and to be careful, but not to go to cash, but just to be careful. And of course, then you ended up rolling. So there's nothing magic. This is really trying to show you what you're seeing on the chart, but visually nicely laid out where you can measure it. And it would be very hard to say, okay, is this, how many ATRs is that from there? And is that bigger than where it was over here? And is this bigger than it's a lot easier to just have it, take that data, put it down, put it in an indicator, and then tweak it the way you need to. And that's just how I like to build my stuff. So a little wall of blue there. So you're making your money in your wall of blue and you're trying to stay light when you don't have a wall of blue. Same thing over here. That one spiked up and then it kind of fizzled. This massive wall of blue here in 23. And here again, and we went over this. This was your 3 waves down. I'm going to bring this down a little bit. Wall of blue here. And then it is really patchy here. And so that's, you've got a little bit that you can trade for a while, and then you're probably losing money, a little bit that you can trade. And that's just the reality of the market. And again, this is much more of a for swing trading than position trading. You would use it for position trading as well, but obviously position trading, if you're holding for weeks to months or maybe even years for some folks, that this is going to be all over the place. So it's more of like, how heavy are you putting on that gas during the time when you're position trading? And then here we had this bear market that we've been going through, and this total wall of of burnt orange, and now we got this little poke up. So what do we want to see now? We want to see that build up like we've seen before. We don't want to go right back down. So if on Monday we come down and go underneath our 21 day, what's going to happen? This blue thing is going to go away and there's going to be nothing there because your high isn't going to be underneath it unless we gapped all the way down underneath, and that would have to be some really bad news. Hopefully that doesn't happen because, I've got a lot of positions on. But it is what it is. If that happens, then I back away, and you live to fight another day. You hop out and then you wait for the next setup. But we had a couple follow through days this week and got our low above the 21 days. So we're wanting to see this build up, and we don't want it to see little baby moves in here. We really want to see this get up into the, the 2s or, 2.5s or higher early on. And you can see, like, let's just go over the Qs. Sometimes when you're looking at the Qs, you'll see these move a little bit higher just because it's only 100 stocks versus all of them. Or here's SPY. Let's look at something slower like an RSP. They all have their different kind of let's look at like an IWM, which has been a dog forever. You can just see that, this is a terrible one. So this would be a one that was studied to like how to stay away from it. So let's just go back to this. So this is this indicator that I've built, the Webby RSI. In the future, I'll share with you this Bob Marley indicator. This is your off high in terms of ATRs, and I've got a lot of things that I've built that let's see, like what I call these. Let's see what's in this one. Muddy. That's not too muddy. Maybe I'll go with my dirty one. Yeah, this is kind of dirty. So these are a bunch of different indicators that I've built that I'll go over on future ones, and we'll certainly go over my ATR indicator up here, and that's that's really important measurement of volatility. But today again we focused in on that Webby RSI. Let me stop sharing here. And I think I didn't really pay attention to the time, but I think I kept this one a lot shorter, probably because I'm going to be doing a little bit of not going to be available on some Saturdays, so I wanted to do these in advance, and because the next couple Saturdays I have some things planned. So, anyways, I try to put these out once a week. That's my goal. Is try to put these out on Saturday so you guys can watch them. I would certainly watch these on 2x speed whenever I'm just talking. But then when you go over the charts, I dial it back down to 1x or maybe 1.25 or so you can really focus in on the charts. I would watch this either on a computer with a big monitor or on a TV so you could see the charts. I wouldn't watch it on a phone unless you're just listening. Maybe you're in the car and just listening, or well, if you're listening in the car, please don't fall asleep. That wouldn't be good. But on walks or whatever, if everyone should be walking all the time. Don't be like I was for so long. I was so sedentary and got so fat and really hurt my health in a major way, just being a workaholic. And I'll do an episode on how I was able to change things around. And it's been man, I was saying this in another video, like almost like 800 days or something like that since I I've changed my health things once, and I'll get into that whole thing. But I don't won't have alcohol the rest of my life. Won't have soda, Diet Coke, which I loved. Oh, Diet Coke was so good, but man, does that cause problems for you? In my opinion. And gluten just kills me, but I love gluten. Everything good in life has got gluten in it, man. I'm just telling you, go gluten free and you'll find that to be true. And so then you throw that on being a vegetarian, which I'm essentially vegan. I do eat some cheese, but besides that, I'm vegan. And so I have to call myself a vegetarian instead of a vegan because there's a big difference there. But I'll do something on that and not ever trying to convince anyone to do anything, but just if you're interested in different approaches in life, and if you're not, you don't have to watch those. No harm, no foul there. There's not a big deal, but yeah, I think that's this one. Let me know what you want to see. Every once in a while on Twitter, I'll put something out like, "Oh, what do you guys want to hear?" Because I'm always looking for that thing that I hadn't thought of, and so some people have mentioned this week of like, how do I go through so many charts and kind of walking through that. And that's something I'll probably um, do because I'll go through at least 4,000 charts a day on a slow day. And lots of times that'll be the same stock, but many times throughout the day and on different platforms and in different time frames, daily, weekly, monthly, intraday. So I'd really call 4,000 charts a slow day. I've never really counted them. This is an estimate. It could be a lot higher. But the point is, on every chart that I look at, I'm trying to learn something. So it's not like when I'm playing through a screen, I'm not just saying, okay, I'm going to play through a screen to try to find the next big winner. Yes, that's what you're trying to do. But I'm trying to look at it, one, to assess the health of the market, what stocks are doing, what groups are acting well, what groups are acting poorly, which ones are making abnormal moves, always looking for what's abnormal. Um, and that's a big deal. And that's why I like to play through so many stocks, and even stocks I will never ever trade under any circumstances, but I'll still play through them. Like during the day, one of the things I will do is I'll dump the entire S&P 500 into a list, as well as basically anything that trades over $10 and over $25 million volume, and that's above its 200-day, dump that into a list, plus anything that's very liquid, and I merge them all into one list. And typically that list will be about 1,300 names or so, and then I'll play through a daily and a weekly of those, and do it I'll do a whole episode on this, and I'll do it within, sort it by like sector as a primary sort, and then maybe composite rating as a secondary sort, to get a feel for the market. Doing that is something I've been doing since the 90s and on an everyday basis. And what it does is it gives you that feel for the market. And there was a one time in there that I got away from doing that. And that was for like a year. It was weird because I had from 2000 until when Bill retired, was that like around 2015, give or take? Some years are kind of fuzzy for me because I'm always so busy and so many things going on in my personal life that for about 15 years, I would do what was called the NESME list, the New Stock Market Ideas list, and it was a list that we would sell to institutions. So you can think of it like kind of like the swing trader that I do with Justin now, or the leaderboard that the other guys do. I'm not involved with leaderboard at all, but they do it more from a orthodox position trading standpoint versus swing trader that I run with Justin that is obviously swing trading related, but it was for institutions. So mutual funds like Fidelity was our biggest client, and I had a bunch of other hedge funds and mutual funds. So they were in there for longer periods of time. So it was geared towards that. So the list would be like 50 to 150 names or so, and I would manage that with him and what goes on, what goes off, and that was what we would talk about throughout the day, every day during trading, and then for about an hour to 2 hours every Sunday night. But there was this change that happened towards near his retirement. It was about a year that, for some legal reasons, that all the PM staff except for one, we couldn't talk stocks with him because we were doing. They decided to do this legal thing, and so he was then running the NESME list with somebody else for that window of time, and I couldn't talk about the market to Bill if I wanted to, nor could any of the other PMs. And he didn't like that, and he got rid of it at some point. He got frustrated with that, and it went back the other way. And I don't remember what year that was, but during that time, at first, I kept on my same routine because I was always having to search for stocks because at any point, Bill would call me up and say, "Mike, looks like the telecoms are really," well, he wouldn't even say the word telecom. Looks like the chips are really running, or looks like retail is really running. Um, let's find some best names in there. And I would have to, I prided myself on, of the top of my head, I would already know that, and that's how I would have value with him, would be being on top of that. And to do that, I would always be looking at everything. Now, that's not the best use of your time from an efficient standpoint, but that's I didn't realize at the time that really gave me a feel for the market, doing that, always searching and always having a watch list. And in fact, my watch list that I do build every day now, I share with the IBD Live folks. Again, that's a paid thing. I don't get paid. Like if we triple our subscribers tomorrow, I don't get paid a dime more. If half of them cancel, nothing happens to me. So I don't try to do this to sell, but I'm just telling you, like, I spend hours a day working on my watch list that I share with people who use IBD Live, and then I separate it into two lists: a watch list, which are what I'm watching now. For that, these days, when I have a parameter on there where I only share ones that have an ATR of around 6 or less, and some around 6.5 or less, that are above their 50-day and above their 200-day, and are above $10 and above $25 million volume. So that universe is relatively small to pick from. Now, I do have a subset, and as I go through and build the watch list, I'll put it in a separate list for myself and then exclude, if I'm looking at something that maybe is still underneath the 200-day or underneath the 50-day, or has a higher ATR than what I think I should be sharing with the general public. And again, an ATR of 6.5, that means on a given day, it trades 6.5% from high to low. And that's a big move. And that's why I don't want to have a lot of these things on that list that are a lot higher, because we do have some very new people that take the IBD Live product, and then they would, I don't want to see anyone get hurt. Like, I'm trying to help, not hurt. So I decided to take out those high ATRs, or if I'm looking at something that's underneath the 200 or underneath the 50, I don't put it on there because a lot of those don't work out. There's some rare cases like a shakeout plus 3 or something, but those are few and far between. And so it's a subset, but I share that every day. So, I'm doing that in the morning, and then midday we send that email out. And like I said, I have my separate list, but I've been doing it that way since the late 90s, a universe list and then a ready list. And I'll do a whole episode on that because it's very important. But in a nutshell, any stock as I'm screening and I see that it looks interesting, I'll throw it in on my watch list, my what I call my universe list. I'm just stock has had a big move on earnings day. It's out of position, but I want to follow it. And so I put it in my universe list. And then I'll play through the universe list when I'm all done. So my general watch list, and to go, okay, which stocks are ready to be bought? Not are good. It's not like, oh, these are my A stocks and B stocks, but it could be a C stock or a D stock that I'm watching. But the next bar, if it were to do something, I would consider buying it. And that's just how I've always operated. I like having a big watch list, the subset of the ready list. And it's just a skill a workflow I developed in the 90s to help me kind of hone in on one. It will tell you, like, if you got nothing on your ready list, that tells you something about the market, meaning there are not a lot of stocks in position, that even if things ripped up, it wouldn't be breaking a trend line or breaking out of a base, or anything was 3 weeks tight, or anything like that. That gives you feedback. And if your ready list is a mile long, that's telling you you're in a really good potential market, that things could really work out. So that gives you, doing that normal routine is helpful. But going back to that story, so for that 1 year, the rule was you weren't allowed, like Bill couldn't even ask you, like, where did the market close today? Like, when Bill would do something compliance wise, it was strict, man. And I'm the same way, very, very, very strict, because you want to keep things clean. And so that was the rule. So we couldn't talk to him. And then I was like, well, I guess I can like enjoy life, right? I don't have to screen through a million stocks. I can only trade what was on our NESME list. So that was him and this other guy picking them. And so I was like, let's call it 70 names or so on average. I can just look at those every day. That's what all the other guys on the team did, and saved a lot of time that way, right? And so I did that, and I really had a lot of extra free time. But what I found is, not doing my set routine, I lost a feel for the market. And after a month or so of doing that, I was really having a hard time in the market because I didn't have this feel and I couldn't figure out what it was. And it was that I didn't have to be ready for that call from Bill, that I was always ready for, always ready for. Even when I'd go on vacation, I'd be like, in Hawaii with the family or whatever. And, the time change, and he'd call me up. I remember being in SeaWorld once with my kids, and we were about to watch a Shamu show, and phone call from Bill, and you got to answer it. I was in the hospital with a loved one, and they were having a surgery, and Bill's calling me, faxing me work. I mean, that's just how the dude was, man. I miss him. Yeah, it's yeah, I miss him. But anyways, that was today's episode on the Webby RSI. I hope you got a lot out of it. That was part one. I'm going to have to probably do a lot of these because we'll do one focused on the burnt orange part, the high underneath the 21. We'll do the something just focused in on the 10, the high versus the 10-day, the kind of a that thing, and we'll also do some on individual stocks. So there'll be a lot with this one, and I'll do some other indicators. But let me know. I'm behind on responding on the comments on YouTube. I got to tell you, I look at them all the time. They make my day, and I really appreciate that people aren't putting negative ones in there. At first, there were some negative ones, like, why is this so long and everything. I think I've explained it. Like, a lot of this is a time capsule for my grandkids, and I just want to have something so they hear these stories in case I'm not around. So I appreciate you putting up with that. And they're free, man. They're free. So don't complain. But I appreciate all the positive feedback and encouragement. And it means a lot to me. It really does. Some of the nicest things that were said over there just make my day. So continue doing that. And if you see things that you want to see more of, certainly let me know either on Twitter at mwebster1971, and that's that whole thing. So what do we got? So now, if this is your first one at the end, you can leave. I like talking about music. Music is something that I really enjoy, and it gives me it's a positive distraction from life, and I've always found it that way. And I think it's a healthy, positive distraction, whether you play or listen to. And so, I know that there's a lot of people that might not know some of the music that I like. And so I'm going to share it, and then maybe, you'll dig it, or some of it. So before we were doing artists, and now we're going to do just one album at a time. Before you know it, I'll run out of artists. So who do we have today? Let's see. We've got the Black Crowes. So, God, this was their latest tour. I got this shirt when they were out here in Austin, and oh my God, it was such a good show. I wanted to go both nights back to back. They were playing at the Moody Theater, which, if you're ever in Austin, it's like the best venue to watch bands, because it's big enough that you get good bands, but it's not so big like the Moody Center. That is like that's a different type of venue. I saw Clapton there for Front Row Center. Oh my God, my ex-boss at the family office out here for my 50th birthday bought me Front Row Center tickets for that. He bought it in the aftermarket, so they weren't cheap, and it was the kindest thing that I mean, who does that? What a nice guy! What a wonderful, wonderful man, and he's got a lot of positive karma in his life for the nice things that he does for people, including doing that for me. But the Moody Theater, that's where the ACL is. If you ever see like Austin City Live, that's you've got everyone's been on that show. Obviously Stevie Ray has been on there. Willie Nelson's been on there a million times, I think more than anybody else, and lots of great people. But they were doing their newest album there, and boy, they have circled back to some good stuff. And there's the two brothers, right? Chris and Rich, that were the Black Crowes originally. Now they broke up. They had some infighting, and some serious infighting. Someone I'm a big fan of, Jackie Green, was actually part of the group in 2013, a member of the group before they broke up for a long time. And they finally mended fences, came back together. I'm a little bummed. I was messed up, frankly, that Chris and Rich decided, because they each had their own bands with their own separate people. And in fact, Marcus King was playing with one brother, and in his band. And so each band, they had their own people. And I think, to just keep it clean, they just started off with all, for the most part, besides the bass player, like just all fresh people, which they're all good and everything, and enjoyable. But, when you go to see an old band, it's kind of nostalgia, and you want to see the old original members in there. So I hope they change, and they bring back either one of the original guitar players, or bring Jackie back in to the fold. But let's share with you the album that I think you guys should start with for the Black Crowes. And I will tell you, like, when the Black Crowes came out with this album, shoot, where did that go? Can't find it. Okay, there it is. Okay, when the having some browser issue. Okay, so when that came, this is on Spotify. So if you want to look at all their albums, just go here, and we're just going to go just albums. And this is their latest one, The Happiness Bastards. And over here, Live at the Greek. I was actually there. And this is when Jimmy Page came and played with it. Oh my God, dude, that was incredible. Oh, it was so good. Jimmy Page, I saw Jimmy with Robert Plant at Irvine Meadows in the 90s when they came back together for that tour. And that was that was epic. But Jimmy with the Black Crowes, I'll do a separate one on that, because Jimmy looks so happy, and it was that was unbelievable. But I'm going to start with their very first album, the Black Crowes Shaker Moneymaker. This is when they first came out, and I think Rick Rubin was the producer on this one, if I'm not mistaken. And it starts off with Twice as Hard, such a um, great tune. Jealous Again, great tune. All these are all great tunes. Sister Luck. What you've probably heard of is Hard to Handle, an old Otis Redding song that they did. Lots of people have done that, obviously. Um, she Talks to Angels is probably that's the ballad that everyone probably knows, is kind of heavy stuff, and all the way down to Hysterical. There's not a bad song on this album. Some of it is kind of on the slower side, like Seeing Things, could I've been so blind. There's not a bad song. I have to say Twice as Hard and Jealous Again are the best ones on here. But it's such a good album, and definitely listen to this one, because this was still in the time frame where this is 1990, where the order of the songs made sense and it flowed. So I would listen to this. Don't do it on random, or I would do it in order, because those things used to really kind of tell a story when you would listen to an album and kind of have a theme through. Those are my favorites. So this was a really good album. We'll talk about their other albums, a different one. So again, Shaker Moneymaker, Black Crowes. If they are touring in your area, oh my God, you've got to see them. It's such a great show, and the brothers couldn't be more uh, more different, and you'll see that in everything that they do. It's like oil and water, man, and it's very much like the Rolling Stones, like Keith and Mick, they're like it's this oil and water thing that really blends together perfectly. And frankly, when I first heard them, I was like, wow, these people are just ripping off the Rolling Stones. Like they're just wannabes, because I was so sad. And if the music didn't come out of the 60s or 70s, it was terrible music. But then I listened to it, I'm like, this just rocks, man. This is good. I don't care that it's new music. Like, this is just good. And then they've had this long career. And so there's so much enjoyment you can get out of healthy things, like just sitting and listening to an album from front to back. And so I hope some of you guys do that. And sometimes, it's helpful just put some headphones on, and just sit there and listen, close your eyes and listen um, to an album that way. And it's kind of like meditating. It puts you in a different state of mind, and sometimes your mind will wander. And I'll find myself thinking of indicators and building new things that I want to build, stock related, as I'm just sitting there, because it's on the subconscious level. Something will just trigger and be like, oh, I should do this and this and this. And so I'll keep a notepad, or I'll have my iPhone there with me, and I'll just jot notes so I don't forget, or I'll email myself. And I need a programmer, because I've got so many things that I've got in my brain that I want to get out while I'm around. And so we'll see how many of those things I can get done. But anyways, the tuition for today, break out your credit card. Not really. Your tuition, as always, is to be kind to a stranger, to a family member, to a friend, anyone who needs it, because it can really change. You can really change the world. If enough of us start a movement, and movements start small. A movement of just being kind to each other. And I'm not perfect, man. I have my bad days, and I get crabby, and act in ways that I wish I hadn't and stuff. So I'm not claiming to be perfect, and I can be very black and white with things. So that's one of the things I need to work on, is being a little bit kinder as I'm explaining to people when they're wrong. Um, uh, Saying it in a nicer way. So that's my to-do list to work on, because sometimes people don't know what they don't know. And sometimes I don't have a lot of patience for that. So I'm going to work on that. But in the meantime, you try to find somebody to be nice to, or a group of people. And it could be as simple as opening up a door for someone who's really in need, or if you see them struggling walking, maybe offer to, help them with their bag of groceries or whatever. Now, some people probably think you're going to steal it, so you got to be a little bit careful there. But just be kind, and let's change the world. I've shared this in one of my other episodes, but I take this so seriously that here's my one of my favorite guitars. Not the most expensive, but this is my Hendrix guitar that I got from off of eBay. There was this. I was looking for a Barncaster, which is basically like a kind of a wooded, like Telecaster, typically that is, kind of looks like old or from like a barn or whatever. And then I was looking for one, and I found this one with this etched in Jimmy on there, and from this little place in El Paso. This little guy, what is his name? Pistol Crown Guitars, and he was selling it on eBay. And then we ended up building, doing all this stuff together. I bought some stuff and he helped me out with it, and got a really nice neck from him. But my favorite thing, and the reason why I broke this out, was what I had custom made as a reminder to myself was be kind. Right there, if you can see it. That's hard to see. Yeah, you can see it. So just always a reminder to myself, because again, I'm not perfect, and no one is. And you've got to be as nice as possible in life, because there is a thing called karma, and if it's for real, man, you want to be on the right side of that. So until then, I've got a couple in the can that we're going to be putting out. I've got a Power Trend, and I went over Chipotle's Move. It's Move. I think it was 2010, and a really beautiful bass in there. So should be a lot of fun for those. I'm not sure what order. I think I'll release this one tomorrow, and the other ones in a couple weeks. So, anyways, peace out, guys, and see you around.